Welcome to HSBC Global Viewpoint, the podcast series that brings together business leaders and industry experts to explore the latest global insights, trends, and opportunities. Make sure you're subscribed to stay up to date with new episodes. Thanks for listening, and now on to today's show.
Hello everyone, welcome to our latest podcast as part of the Perspective series. We're recording here in London on the sidelines of the GCC Exchanges Conference. My name is Murat Ulgen, I'm the Global Head of Emerging Markets Research, and I'm very, very pleased to be joined by a very distinguished guest, an esteemed colleague from the industry, Mr. Yerlan Syzdykov, Global Head of Emerging Markets at Amundi. Yerlan, welcome.
Thank you very much for having me.
I mean, there are lots to talk about, a lot of things going on in the investment environment, and this podcast is about emerging markets, which you're an expert of. But perhaps a good place to start is on a more personal basis. We would like to get to know Yerlan better. So can you tell us a little bit about your career, walk us through how it's progressed, and your current responsibilities?
Absolutely. My name is Yerlan Syzdykov. I come actually from Kazakhstan, which is in itself emerging country. So I can say that I lived all my life in emerging countries and now following emerging countries. So I've been pretty much most of my career, I've been on the fixed income side, so last 25 years. And today I'm responsible for both fixed income side, but also on the equity side. The way that we build emerging markets is actually as a platform whereby we combine both equity and fixed income under one umbrella, which I think distinguishes us as one of the strongest players that have 360-degree approach to emerging market investing.
Excellent. Thank you, Yerlan. No, this is great because I think that's the way the industry is moving as well. So great to have the context. But let's dive straight into the outlook of emerging markets for the remainder of this year, for the second half. And obviously, an eventful first half. We've got so many things going on. Trade tensions, tariffs, on and off. We had bond market volatility, geopolitics, what have you. So what's the outlook for the second half of the year across the asset classes?
We're looking at a big theme of reallocation of flows from the United States today into other markets. And I think distinguishing places that we believe that this money is going to flow to and continues to flow to is Europe and emerging markets for various reasons. So it's diversification away from the US that is starting to really affect the flows into emerging markets. And I think this is really a great opportunity for us to look at emerging markets as a value proposition. So if we're talking about equity, we see significant undervalued assets. We know China is very cheap. We have growth opportunities, and among which I think GCC clearly is one of them. Maybe it's not universally perceived as cheap, but I think there's still great opportunities to invest in GCC. And of course, India. This is another engine of growth where we see 6% growth for the next decade that India is capable of growing. And therefore, for us, even the valuations are relatively tight, we still continue seeing opportunities in India that will abound. If you think about fixed income, of course, this is an opportunity for local currencies because we know that de-dollarization means that weaker dollar probably will continue to proliferate. That means that emerging market fixed income will receive more money, we believe, going forward into local currency markets, which so far has been pretty much neglected, I would say, in the last 3 years in terms of flows. So we've seen fixed income overall attracting more money, hard currency and corporate sovereign markets, but specifically now seeing interest towards local currency. And what is interesting, I think we're also looking at an opportunity to invest into single country markets where for the first time, I think in the last 4 or 5 years, we've seen an opportunity to invest into Chinese markets on a local currency basis and India. So standalone country allocation has been quite rare, but now investors are looking to really go into these specific areas to invest in. So I think this is the way that we're looking at the development of the market for the next half of the year. Of course, the biggest challenge for us was going to be to understand how the current environment, especially the conflict in the Middle East, will affect our inflation and growth outlook.
Sure.
And of course, that is going to drive a lot the global monetary policy. But I think the overarching picture for us is a very positive one, where we also believe that the gap or the alpha delta between emerging market growth and developed market growth is going to continue widening, as we're seeing the U.S. growth is starting to go down, so we're looking at 1.6% for the next couple of years, whereas on average, emerging markets growth is going to hold up. So I think we will have a gap widening, which is typically also a very bullish sign from emerging market perspective.
Excellent. And actually, Yerlan, there are so many areas we're in agreement because we thought this year, particularly after the trade tensions, Liberation Day, etc., with the US dollar softening and weakening, we thought this could be a moment for local currency assets, starting with local currency debt and then spilling over into equities. And now I look at performances year to date, and they've done really, really well. So now I'm scratching my head. I mean, yes, we're directionally bullish, but the performances are strong. Do you think that's an impediment, or would you say local currency assets have been neglected for such a long time that there is more legs to this trade?
I think there are two kinds of investors that we're working with. Of course, we have retail investors who are potentially looking at, with a lag, at the performances. Yeah. So they really act on the past performances. So when they see that the local currencies are performing spectacularly this year in dollar terms or in euro terms, they're actually trying to come and buy these markets, notwithstanding already performance has been very strong. And then you have institutional investors who for the years have been looking at local currency market as maybe a less efficient way to invest into emerging markets, specifically because they're looking at information ratio and saying, well, look, volatility because of the FX component is much higher. Returns were lower than they were in hard currency terms. So why bother, basically, right? So we're seeing, of course, after this 2 years of relatively decent, from the emerging market perspective, performances, they're starting to rethink that, because obviously that's changing a little bit the perspective. Of course, it depends on what period of time you're looking at. But in the last 5 years, if we continue with this trend, next year is going to be very interesting. And the fact that some of the institutional investors are coming into certain markets, as I mentioned to you, away from the dollar assets and into the specific Indian market or specific Chinese market, for example, in a local currency terms, which I haven't seen before, to be honest with you.
Mm-hmm. Mm-hmm. No, it's an excellent point. And you mentioned about this global monetary policy outlook, and obviously it looks like we're in an easing cycle. I mean, yes, the US Fed is currently on hold, well, at least that's our expectation, but we expect them to resume rate cuts later in the year, September, December. But the rest of the global center banks, ECB, New Zealand, India, South Africa, Korea, they're all cutting rates. So that gives you a backdrop. Perhaps the front-end rates are coming in lower. But then we had big bond market volatility, either back-end in Japan or the US, some term premiums building based on the fiscal issues, etc. Do you think that's a problem for investing into emerging markets, that is, term premiums rising? Or is it like confined to more fiscally challenged economies?
It's a great question. I think it affects obviously the sentiment. When you're seeing these wild gyrations on global markets, on the core markets like US, you're obviously having effect on the sentiment in global fixed income markets for sure. But what is very interesting is that we're looking at the problems that are being addressed by so-called bond vigilantes now, specifically those problems that we normally address for the emerging markets. Now, for years, we've been effectively acting as investors, bond vigilantes for emerging markets. So I think, therefore, a lot of questions that we have about fiscal policy stance and how we actually can frame that within emerging markets are going back to haunt some of the developed markets. No? So we're in a way we graduated from those issues, those problems, right? That's one thing. And then the same issue we discussed with you for the years is independence of central bank, which is an issue that now we're discussing in the context of United States, right? So and that is very interesting because we talk about Turkey, we talk about other markets where we have challenges on that front, but we've been there. So investors, in our case, are used to deal with those issues. Whereas I think a lot of investors who are developed market investors, they're not really used to deal with issues of that kind of nature. No, so for us, it's easier from the sentiment perspective to go through this. But of course, we're gonna have to see the effect of steepening curves globally on emerging markets. That's for sure. But the issue here for us is to see how central banks are going to anchor the rates and inflation expectations within their countries. And I think they're doing a much better job, to be honest, than Fed.
I couldn't agree more with you because you and I, we spent our careers on following emerging markets, and now I would think in this current global context, the emerging market lens becomes very, very handy looking at the rest of the world. let's shift gears a little bit and go perhaps deeper into regions. I mean, you did mention a few of them, but maybe I'll bring up Latin America. Doing a survey for institutional investors like yourselves, the latest one we published towards the end of March, but it was the outlook for the second quarter. And we were already seeing some signs that investors were warming up to Latin American assets because 2024 was different for Latin America, more volatility, but beginning of this year, going into the second quarter, there was good interest. Is that something that you would agree, starting with Latin America and maybe other parts of the world as well, across emerging markets?
Latin America, to us, potentially could be in a scenario of global slowdown when we have U.S. growth slowing, European growth slowing, and generally global growth is being challenged. I think Latin America probably will have to contend with lower commodity prices going forward. So I think this is obviously a very much cliche, but we're looking at exposure to commodities, global exposure to commodities, and it's obviously a big chunk and bulk of what we invest into in Latin America. So I think we have to be careful and look for opportunities outside of some of the countries that will be exposed. Of course, we can see that the trade and tariff situation will also affected some of the sentiment. We talked about Mexico and how it was affected, but in reality, I think this is going to be a great opportunity to invest in Mexico over the next decade, potentially, because I think that region probably will be more shielded from that tariff pressure that we know is going to be moving towards east of the world. So I think for us, we're very cognizant that this is going to be more safe from the geopolitical perspective, from the trade flow perspective, countries, but also challenged because of a lower commodity pricing.
Mm-hmm. Excellent. And talking a little bit deeper about GCC region, now that we're recording this on the sidelines of our GCC conference, you did mention that you're generally constructive, structural growth story. But is it across the region, or do you have any preferences? I mean, obviously we have, some dependence to oil, even though this is being diversified, non-oil economies are growing. But then you also have Egypt, which, has done a lot over the years, but still some dependence to external funding, etc. So do you make some differentiation or generally positive about GCC?
I can obviously talk very, very generally about regions. Of course, we do significant differentiating factors that determine our allocations. So from the GCC perspective, we're looking at stable countries and stable from the perspective of the budgeting, from the fiscal perspective. And we're looking also at high growth opportunities, more dynamic countries, probably more countries with a more dynamism. That I actually have been in a region a couple of weeks ago, so I'm very lucky to come to this conference again and then to meet even same people at this conference. But the impression I got there's a lot of dynamism that's coming from the UAE. I think to us is the most dynamic economy. In a way, it's a connector economy that helps a lot of regional trade, builds up a lot of trading flows. And in a way, it's also the country that allows for growth in the commodity business, in the in information technology business. So there's a very conscious opportunity to pursue these policies for the policymakers in UAE. So I think this is the most probably stable and also growing story for us, stable from the fiscal perspective, because the oil prices in the budget, they are in the mid 40s. I think they're going to be very comfortable to balance the budget at that oil price, and they're less dependent on that compared to other names in the region. So outlook for other names in the region, of course, is going to be a bit more mixed because some of them probably overextended on the fiscal side. So they have to be looking at the measures that will balance the books, so to speak, to bring more confidence. They have to look for the funding opportunities. And of course, that's going to affect the way that we treat sovereign, quasi-sovereign, and also curves, as you mentioned, in the overall steepening bias. And of course, we need to understand how the investment projects that they have, they're obviously transformational in nature, how they will be affected by that belt-tightening exercise, if you want. So I think this is kind of the region that is still very, very, very much into the growth, with a very much strong policy mix overall towards investing, towards consumption. But we need to be careful about how budget will affect that growth pattern. And of course, there are other areas which are probably a little bit more concerning. That traditionally, maybe the weaker countries that, from the fiscal perspective, we know which countries they are. But overall, the region is booming. We're seeing consumption patterns. We're seeing demographic patterns. We're seeing also women participation. That is all going to really fuel that growth opportunity for us for the next decade.
Totally agree with you. There are lots of structural forces driving growth. We are, as a team, economic strategy, we're very constructive. But I suppose one thing perhaps I can add is our economists have done a lot of work on Asia and MENA trading corridors. And this is quite interesting because you might argue there is a global context of geofragmentation, but then you have regional integration. So the economists, they think the Asia-MENA trade corridor, the total two-way trade, can actually more than double over the next decade. Same for investment opportunities, UAE-India links, China-Saudi Arabia links, which are really very, very strong. So no, totally agree with you, Yerlan. Maybe I can bring the discussion back to the beginning because you said something very important, reallocation of some capital out of the US, which is something we also follow very closely. We get a lot of questions about it. Is this like an expectation? Or do you see it in numbers? Do you hear anecdotally that some capital is being reallocated? Or is it more the case of extra surpluses will be invested elsewhere around the world, searching for some other alternatives because the rest of the world is already invested a lot in US financial markets?
No, I'm giving you an anecdotal evidence from our client behavior. Of course, we can look at overall numbers, and I'm sure you know much better overall industry numbers than I do. But from our perspective, we're seeing reallocation of one mandate by a sovereign wealth fund away from U.S. credit into emerging markets fixed income, for example. Now, it's a significant mandate, and we're happy to see that mandate coming to us. And we're also seeing a lot more inquiries into the countries which were maybe shunned before by U.S. investors or by European investors. No, so this is kind of also another way to think that maybe this is going to be diversification into some of these beaten up countries that didn't really have a lot of interest. What we observe very strongly today is flows, especially on the passive side, into Europe. Away from the US passive side into European passive side. And I guess the expectations are fueled by already depreciation of the dollar this year against euro, and also expectations that this potentially, the factors that are behind it are still there. So potentially there could be a bit more of a depreciating factor. The fact that European ECB, European Central Bank, stopped or announced that they're stopping adjustments to their monetary policy, and whereas the expectation that Fed is going to do still 2 more cuts, starting, we believe, in September, probably also fueling that expectation that we're probably going to see a lot more stable and interesting appreciating opportunity for European assets. So I think that's what we're seeing a lot. Maybe in the emerging markets it's not as pronounced, but European markets are very clear trend.
Excellent. Going back to your role and your institution, I mean, lots to navigate through in this global context. Things change almost on a daily basis. So what's the Amundi strategy going towards the rest of the year? How do you navigate this landscape?
We as a company see a significant growth opportunity from the asset management industry perspective in Asia. This is about demographics. This is about the patterns of investing. So we're starting to move and invest a lot more into our capabilities on the Asian side. And I'm sure that you are also have built this capability in a significant way. So I think this is what we're looking at, the opportunity to really improve our setup and invest more into Asia. This could be going directly, going to these countries and setting up our businesses, or could be through joint ventures. To give you an example, we have a joint venture that we formed in India. Almost now it's the 3rd decade of our partnership with the SBI, State Bank of India, and now today, it used to be about 300-400 million when we set it up. Back then, today it's 300 billion under management. So it's a significant contributor to the bottom line of Amundi as a joint venture. So we built this kind of joint ventures across different markets, and I think this is going to proliferate, especially also given that growth opportunity now is in GCC. We're also looking for opportunity to build some of the partnerships in the region. So I'm not going to give names, but I think we're working on that. It was part of my mission when I was also in the Middle East. The other big theme that we're playing is, we discussed it in the past as well, HSBC has been very much committed to sustainable finance in the emerging markets. And I think we have been also one of the players in this market, as you know, as we discussed many, many times. And I think what we have seen also as a trend, going back to your previous question, that a lot of reallocation is starting to happen from, say, even US institutions towards ourselves or institutions with very strong credentials in sustainability financing. Of course, we know there's some of the setbacks. If you think about US big asset management companies, that they started to roll back some of their promises and commitments on the environmental and climate side. So I think we're seeing that being a major factor. To name a few opportunities, we have had a significant opportunity from UK pension fund that moved away from the US asset manager and awarded Amundi with a mandate specifically because the sustainability commitments have been effectively removed by the previous asset manager, and whereas they saw that we are pretty much on course. So I think this is going to be also a very important part of the emerging market business, where we're looking at opportunities in Saudi Arabia. We're looking at opportunities to invest in broader region into hydrogen production, into sustainable energy. We're looking at to finance solar energy in the region as well. So I think there's a significant amount of opportunities for us to channel investors' money at the time when we're all going through a very challenging times on the sustainability side, given that lack of commitment of certain players. And I think this is the time for us to step up, and I hope HSBC is going to help us as well to channel those investments into emerging markets in sustainability investments and financing opportunities.
Fantastic. So a very busy rest of the year for you. And Yerlan, this is a fascinating conversation, very insightful. And I think it's fair to say that the name of the game in the global investment environment is uncertainty. But emerging markets are firmly on the map for investment opportunities, a constructive view I think both you and I share, and would be also looking for opportunities around the emerging market landscape. So thank you very much for joining us. I really thoroughly enjoyed it, and this was super helpful and very informative. So ladies and gentlemen, I've had my distinguished guest today, Yerlan Syzdykov, Global Head of Emerging Markets at Amundi. Really great discussion, recording on the sidelines of GCC Exchanges Conference here in London. This was the latest on our podcast series on perspectives. Please stay tuned for the upcoming ones. And once again, Yerlan, thank you so much for joining. Thanks, everyone.
Thank you, Murat.
Thank you for joining us at HSBC Global Viewpoint. We hope you enjoyed the discussion. Make sure you're subscribed to stay up to date with new episodes.